Since the Great Recession, federal law requires all lenders to prove a borrower's ability to repay their home mortgage using current recurring income. This has led to the strict home loan guidelines we see from Fannie Mae, Freddie Mac, and the FHA, and from the banks. They want to see high taxable income, which is often the exact opposite of what you as a business owner and your CPA want to see at tax time. That's where non-QM or non-qualified mortgages come in. These are not subprime loans. They are specialized products for high net worth or self-employed individuals. Over the last few years, 3 non-QM options have become the gold standard for business owners. Welcome to Abundance 99. Elsie Wu. Along with my husband Eric Sit, we operate a one-stop shop dedicated to helping our clients achieve their financial goals through real estate. This is the second of our 3-part series on home loan options for the self-employed. In the first video, we shared the lender's definition of self-employment, a survey of the 6 most popular loan products for the self-employed, and offered our top 5 pro tips to get you ready to buy or refinance your home in the next 12 or 24 months. In this video, we'll do a deep dive on these 6 loan products and their pros and cons so you can decide which options are best suited for you. Let's dive in. First, conventional loans. These are backed by the government-sponsored enterprises Fannie Mae and Freddie Mac, which basically means lenders can originate these loans and sell them to the government-backed entities. These loans are generally full doc with full underwriting, but they offer the lowest interest rate and low down payment options. The lenders want to see income stability and continuity. They want 2 years of personal and business tax returns, all schedules. They want to see your year-to-date profit and loss statement, business license, and oftentimes they allow you to add back depreciation, depletion, business use of home, and business miles as your qualifying income on the loan. If you have been in the industry for 5 or more years, sometimes they will allow you to use the most recent year tax return only for qualifying. Or if you have been in the industry for 2 years before you started the business, sometimes they are okay in taking just 1 year's tax return for qualifying income. Lenders will want to see increasing revenue. So if they see that your income is declining for more than 20%, they will often disqualify the loan. They allow 45% to 50% debt to income ratio. Of course, lower is better. They require higher reserves if your credit scores are lower or your DTI is higher. They allow you to use your business assets, your business checking account for down payment if you have 100% access to that account, and you using that money for down payment does not adversely affect the business viability. Now, Fannie Mae and Freddie Mac have a 3% down payment option for first-time home buyers, which is very attractive. And sometimes they have the lowest interest rate among all loan options. They will require private mortgage insurance until you have 20% or more equity. Option 2, FHA loan. This is another government-backed loans, and this is specifically targeting people who have higher debt to income ratio and lower credit scores. They allow up to 56.9% debt to income ratio and credit score as low as 620. They have lower or no reserve requirements, which is also beneficial for self-employed. They want to see 2 years of income, and the property must meet health and safety codes. And this is often a concern for real estate agents and sellers. FHA loans also have a drawback of requiring both an upfront mortgage insurance premium and a monthly premium for the life of the loan, even if you have more than 20% equity. And of course, these costs can add up. Unlike option 1 and 2, which are backed by government-sponsored entities, jumbo loans are generally held by banks in their own portfolio and not resold to government entities. And this comes into play because Fannie Mae, Freddie Mac have a loan limit of $1,249,000 as of 2026, even in the high-cost areas such as the Bay Area. So for loans above that limit, then borrowers have to go to a jumbo loan, and therefore banks will have to hold on to those loans in their portfolio. Jumbo loans typically have tighter underwriting, and lenders will often require 12 to 24 months of reserves and may also require 2 appraisals for loan amount exceeding $2 million. Of course, that limit may vary from bank to bank and region to region. So these three are the most popular loans and do about 90% of the home mortgages in the US in 2025. Now, the next three options are the non-QM options that we mentioned earlier. These are loans provided by Wall Street enabled vehicles. The most popular right now for small business owners are these bank statement loans. These lenders will require 12 to 24 months consecutive bank statements. They will add up the deposits of these bank statements, 50% of the deposit as income for loan qualification. They're okay if you haven't filed your tax returns. They're okay if your income is seasonal. Sometimes this bank statement loan will give you higher qualifying income if you have aggressive tax deductions versus the Fannie Mae, Freddie Mac loan options. If you're working a service industry that, for example, has lower expense ratio, and if your CPA is willing to provide a letter documenting your history of lower expense ratio, some lenders will allow you more than 50% of the business deposits as qualifying income. But not all CPAs will provide such comfort letters. The interest rate is higher on these bank statement loans. They often require higher down payment, and the lenders will do detailed deposit verification to confirm that you're not transferring money from your other accounts into this business account for the purpose of getting a loan. Option number 5, 1099 only loans. These are simple loans and great for self-employed in the service industry that have a lot of 1099s and not a lot of expenses. In these loans, lenders often allow up to 90% of your total 1099 to qualify. No tax returns are needed. However, they will only allow 1099 incomes from contracts that are still active. So if your contracts come in and out on a regular basis, that may not apply. They also require higher minimum credit score of 660 or higher than Freddie Mae, Mac, and FHA allows. And they often require more reserves, 12 to 24 months, for example. Option 6, asset depletion loans. This loan is gaining popularity as well, especially for people who have recently sold their business with no current income or people who are retired. They will look at the stock portfolio statement. They'll take 70 or 80% of the balance, divide that by 60 to 84 months. And they use that number as if it's your monthly income to qualify for the loan. And this can work as a standalone income qualification or as part of a full doc supplement. For example, if you're retired, your spouse has a W-2, but the W-2 income by itself is not sufficient to qualify for the loan amount you want, then you can also use the portfolio statement as additional income to qualify for the loan amount. And you do not have to liquidate or deplete that bank account, even though it's called asset depletion loan. A few other details. First, they won't give you 100% of your stock balance. They'll give you 70 to 80%. They want the asset to be seasoned. So if you've just recently sold your business or your Bitcoins and moved the money into your bank account, that needs to be seasoned for 60 to 120 days. If it's a jointly owned account, they will verify that you have 100% access to the account. Only fully vested transferable shares will qualify. If you use your 401k or your IRA portfolio to qualify, they will factor in tax and early withdrawal penalties for loan qualification. So these are the 6 options most frequently used by the self-employed to qualify for a home loan. The first 3 are government-backed or bank loans. Next 3 are the non-QM loans from Wall Street. Because Wall Street investors buy these non-QM loans, the rules change based on the economy. When things are booming. Lenders compete for your business with lower rates and easier terms. When the market feels uncertain, they tighten the belt. This is exactly why working with an independent mortgage broker matters. Unlike a traditional bank that only has its own menu of products, a mortgage broker has access to dozens of non-QM lenders. We shop to find the one lender whose current guidelines actually fit your unique financial fingerprints. Click below to watch part 3 of this 3-part video series on how successful business owners use their active income to build passive wealth, and call us at the number on your screen to review your specific scenario.